You're about to discover why the worst financial decision in human history might actually be the smartest thing anyone ever did. On May 22, 2010, a programmer named Laszlo Hanyecz made a trade that would eventually be worth over $1 billion. He paid for dinner. 2 Papa John's pizzas. That's it. No mansion, no stock portfolio, no life-changing financial instrument, just cheese, pepperoni, and toppings. For the next hour, we're going to reconstruct this moment, not as a tragedy of regret, but as the genesis moment of modern finance. Because what if I told you that this wasteful pizza purchase actually saved an entire economy? Welcome to the story that changes everything you think you know about value, technology, and the future of money. Picture this, May 2010. A man sits in front of a humming computer tower. The cooling fans drone like a distant helicopter. The blue light from 3 monitors illuminates his face in a dark room. His name is Laszlo Hanyecz. He's a developer. He's bored. He's also broke in the way that crypto pioneers always are, surrounded by digital abundance, while his bank account reads something that would embarrass him at the grocery store. But here's what you need to understand about May 2010. The world is on fire. Well, actually, partially literally. 2 weeks before Laszlo posts his now famous pizza message, something happens on Wall Street that should have sparked revolution. Instead, it sparked panic. It's called the flash crash. A massive sell order hits the market, then algorithms kick in, then more algorithms, then more. Within minutes, literally minutes, the Dow Jones Industrial Average plummets nearly 1,000 points. 9% of the market's value vanishes. Procter & Gamble, the company that's been making toothpaste since your grandparents were born, drops 37%. Accenture, a massive consulting firm, trades for a single penny. 1 penny. Blue-chip stocks are trading at prices that make them cheaper than gas station coffee. The mainstream media calls it a fat finger error. A trader accidentally hits the wrong button. Whoops, $1 trillion oopsie. Let's move on. But in the forums, they see something different. They see the fragility of the entire system. They see a house of cards that collapses when a secretary sneezes. They see proof. Scientific, undeniable proof that everything they've been warning about is real. This is the context. This is the soil. Simultaneously, Greece is burning. Literally. Riots in Athens. Deaths in bank fires. The European Union is assembling emergency bailouts. They're printing money to cover debts. Inflation spirals. Central banks breach the trust that took centuries to build. And Laszlo Hanyecz is watching this. He's a technologist. He understands systems. He understands failure points. He has 10,000 bitcoins. These aren't just coins. They're the output of his innovation. He invented GPU mining. He figured out how to use graphics cards, the same technology gaming enthusiasts used for video games, to mine Bitcoin faster than anyone else on the network. For a brief window in 2010, he is the heavy industry of Bitcoin. He has approximately 100,000 BTC total, 100,000 coins from a network worth essentially nothing. Now, think about that for a second. You're sitting in front of a computer. You've created something. You've mined something. You're essentially printing money, except it's not money, not yet. It might never be. There's no market. There's no established price. It might be worthless forever. It's probably worthless forever. So you have all these coins, thousands, tens of thousands, mountains of digital abundance that might as well be sand. What do you do? Laszlo Hanyecz decided to test it. But before we get to that moment, we need to understand the protagonist on the other side. Because this transaction doesn't happen without Jeremy Sturdivant. Jeremy, known online as Jerkos, is 19 years old. He's a student in California. He's young enough to believe that technology could reshape the world. He's ideologically committed to the idea that currency should be peer-to-peer. He believes money should flow without banks, without government, without intermediaries. He also doesn't have much money. This is crucial. When Laszlo makes his offer, Sturdivant will have to front his own money, his real money, his credit card, to purchase 2 pizzas for someone he's never met, in exchange for digital tokens that have 0 guaranteed value, 0 established market, 0 historical precedent suggesting they're worth anything. This isn't a passive transaction. This is radical faith in a concept. Let's go deeper into the network itself. May 2010. The network hash rate, the total computational power securing the network, is tiny. We're talking hobbyists, basement miners, dorm room experiments. There are no exchanges, no Coinbase, no crypto custodians, no ETFs, no regulatory framework, no Twitter accounts called Crypto Bro posting hype. There's just code, pure, elegant code. Picture the infrastructure. The original Satoshi client, Windows 98 looking software, grey buttons, clunky interface, command lines. Pre-Twitter even, in its current form. This is the deep web before the deep web became a cliché. The network is so sparse that when the pizza transaction occurs, it's the only transaction in block 57,043 besides the mining reward. Think about that, a block of the blockchain. Forever. And it contains the first commercial use of Bitcoin, the first moment where digital code becomes physical pizza. On May 18, 2010, at W1035,001 UTC, Laszlo creates a forum post. The title is simple, Pizza for Bitcoins. But it's not a joke, it's a proposal. He writes, I'll pay 10,000 Bitcoins for a couple of pizzas, like maybe 2 large ones, so I have some left over for the next day. I like having leftover pizza to nibble on later. He's not trying to acquire real estate. He wants leftovers. He wants to have pizza tomorrow. The mundanity is extraordinary. He's treating these 10,000 coins, each one the product of hours of computation, like their pocket change, like their lunch money. Because to him, they're abundant, they're free. He continues, you can make the pizza yourself and bring it to my house or order it for me from a delivery place. But what I'm aiming for is getting food delivered in exchange for bitcoins where I don't have to order or prepare it myself, kind of like ordering a breakfast platters at a hotel or something. They just bring you. He specifies his preferences with the carefulness of someone who's thought about this. Onions, peppers, sausage, mushrooms, tomatoes, pepperoni, etc. Just standard stuff, no weird fish topping or anything like that. For 3 days, nothing. Crickets. A forum user called Bitcoin2Pays expresses interest but lives in Europe, logistically impossible. Another user called Enderex does something interesting. He actually does the math. 10,000 coins is quite a bit. This could potentially be sold on the Bitcoin market for 41 USD. This is the first time someone publicly flags it. The pizza index disparity. Laszlo is essentially paying a premium, maybe willing to overpay. By May 21, Laszlo is getting impatient. He posts again, so nobody wants to buy me pizza. Is the Bitcoin amount I'm offering too low? The irony is suffocating when you know what happens next. When you know that 15 years later, 10,000 Bitcoin will represent the GDP of a small nation. But in the moment, in May 2010, it's genuine confusion. Is the offer not generous enough? Does nobody believe Bitcoin is worth anything? Then, on the afternoon of May 22, something shifts. Jeremy Sturdivant sees the post. He sees an opportunity, not to get rich, not to speculate, but to prove a point, to prove that Bitcoin works, that it can actually purchase things, that it has utility. He contacts Laszlo via IRC. This is the dark mode of the internet. Black background. The command line environment where the real business of early internet culture happened. It's where hackers lived, where anonymity was default, where ideas were tested in real time without corporate HR departments, or brand guidelines, or social media managers. I can get those pizzas for you, Sturdivant says. Laszlo, okay, I'll send the 10K. That's it. That's the entire negotiation. because they both understand what's happening, they both get it, they're not haggling over pennies, they're testing the foundation of a new system. Sturdivant navigates to the Papa John's website, or calls. The records are slightly unclear, but the mechanics don't matter. He places an order, 2 large pizzas. The specifications are met. He puts it on his credit card, $35, $41. The sources differ slightly, but the ballpark is consistent. The pizzas are prepared, they're loaded into a delivery vehicle. A delivery driver who will never know what just happened brings them to Laszlo's house, in Jacksonville, Florida. Somewhere near the coast where the climate is hot and humid, and the pizza box will grow slightly soggy in the afternoon heat, the pizzas arrive. Laszlo takes photos. Then, and this is crucial, he sends the 10,000 BTC. The transaction broadcasts to the network. It gets included in block 57,043. The fee is 1 BTC, so the total cost is actually 10,001 BTC, the first transaction fee, the first Bitcoin payment for a physical good. The photos are distinct. They're not the famous ones everyone thinks they are. This is important. There's no IA3 Bitcoin t-shirt on the kids. That comes later, in 2018, when Laszlo buys pizza again. A second-layer scaling solution that makes the transaction instant and nearly free. But in 2010, the photos show what they are. 2 Papa John's boxes. Open, thick crust pizza, greasy. Laden with toppings. Utterly ordinary, except for the tiny hands reaching in. Just hungry kids, eating dinner that was purchased with code and electricity. The harsh light of a 2010-era digital camera flash illuminates everything. It's not glamorous, it's not dramatic, it's dad buying dinner, except it's the most important dinner in the history of finance. Here's where everyone gets it wrong. Papa John's did not accept Bitcoin. Papa John's corporate has never accepted Bitcoin, not in 2010. Not now. Jeremy Sturdivant acted as the intermediary. He was the first exchange, the first payment processor. He assumed all the risk. He fronted his own money. He believed in the concept enough to bet real currency on it. This is undersold in the narrative. Everyone remembers Laszlo. But Sturdivant, he's the actual hero. He's the bridge. He's the person who said, I believe this so much that I will put my own cash on the line. And here's another misconception. Laszlo is not broke. Laszlo is not destitute. Laszlo is not wandering around in 2025 bemoaning his lost fortune. He works at Gruck. He's the head of development for an application that integrates Bitcoin payments. He held on to some Bitcoin. He held on to Bitcoin Cash. He's repeatedly stated, directly, clearly, without hedging, I have no regrets. Why? Because he understood something that most people still don't. The coins weren't an investment. They were the byproduct of a hobby. He describes it as winning the internet. His exact words, I wanted to do the pizza thing because, to me, it was free pizza. I mean, I coded this thing and mined Bitcoin. Usually, hobbies are a time sink and money sink, and in this case, my hobby bought me dinner. Coins are value when they move, when they circulate, when they're exchanged for goods and services. Coins sitting in a wallet are abstractions. They're theoretical. They're numbers on a screen. Laszlo's GPU mining innovation triggered a rare and revealing intervention from Satoshi Nakamoto himself. Before Hanyecz, Bitcoin mining was done on CPUs. The vision was democratic. 1 CPU, 1 vote. Anyone with a computer can generate some free coins, Satoshi wrote. That was the selling point. Decentralization through accessibility. Hanyecz realizes that graphics processing units, the chips in gaming computers, can do this, work orders of magnitude faster. He writes the code. He becomes, for a brief window, the heavy industry of Bitcoin. He's not just a participant, he's the monopoly. He's consolidating power through technology. Satoshi gets wind of this. He reaches out. And in the correspondence, he reveals something about his psychology, something about his fear. His exact words, a big attraction to new users is that anyone with a computer can generate some free coins. GPUs would prematurely limit the incentive to only those with high-end GPU hardware. It's inevitable that GPU compute clusters will eventually hog all the generated coins, but I don't want to hasten that day. Satoshi is begging Hanyecz to suppress this innovation, to sit on it. Not to release the code, not to democratize access. Hanyecz complies. He doesn't publicize the GPU method, he slows his advertising. But here's the thing. The genie is already out of the bottle. It gets discovered anyway. Within a year, the ASIC miners arrive. Purpose-built computers that obliterate GPUs. The democratization of mining ends. The professionalization begins. Satoshi's worst fear comes true. And what does Laszlo say about dealing with Satoshi? Weird, paranoid, and bossy. This is the creator of Bitcoin, the architect of a trillion-dollar economy, described as paranoid and bossy by someone who just wanted to test pizza. To truly understand the weight of Laszlo's decision, you need to meet his dark mirror. James Howells. James also mined Bitcoin early. James accumulated 8,000 BTC on a Dell XPS laptop in 2009. That's slightly less than Laszlo's pizza run, but still 8,000 coins. Then, in the summer of 2013, James cleansed his house. He's doing renovations. He needs to clear space. He's not thinking about Bitcoin. It's been dormant. It's not trading. It's just sitting there. So when he encounters a hard drive, a small piece of black plastic and circuitry containing the private keys to 8,000 BTC, he doesn't recognize its value. He throws it away. It goes into a bin liner. It goes to the Newport landfill in South Wales. For years, nothing. Then Bitcoin starts rising. $10, $100, $1,000. James realizes what he's done, gradually, horrifyingly. He watches the value of the buried hard drive climb. 1 million, 50 million, 100 million, 300 million. By early 2025, the buried drive is worth approximately £527 million, $750 million. To put that in perspective, that's more than the GDP of Iceland. That's more than the market cap of most public companies. That's more than the combined annual revenue of the NFL, NBA, NHL, and MLS. And it's in a landfill. James becomes obsessed. He assembles teams of experts, environmental scientists, AI specialists, excavation equipment operators. He proposes a surgical dig of the landfill. The Newport City Council refuses. Environmental risks, they say. Legal complications. James sues. He claims conversion of his property. He demands £495 million in compensation. The case goes to the High Court in Cardiff. Once the hard drive hit the landfill, legal ownership transferred to the council. Under the Control of Pollution Act of 1974, that's how it works. The property is no longer his, it's public waste. The court dismisses the claim. No realistic prospect of success, the judge writes. James Howells loses. He doesn't get to dig, he doesn't get the coins. He doesn't get anything except the knowledge that his fortune sits, encrypted and irretrievable, beneath tons of British garbage. And he describes his mental state as daily bloody torture. Here's the profound contrast. Laszlo Hanyecz spent 10,000 BTC on pizza. He received satisfaction. He proved utility. He helped bootstrap an economy. He looks back with pride. No regrets, he says. He means it. He petitioned councils. He assembled dig teams. He invested his own capital in a lawsuit. And at the end, he got nothing except the ache of loss. The lesson writes itself. Utility yields legacy. Hoarding yields anxiety. The Bitcoin community celebrates locally. A few forum posts congratulate Laszlo. "You are the pioneer," someone writes. "The mood is one of quiet validation. The theory works. Digital money can buy physical things. It's slow, it's clunky, it requires intermediaries. But it works." But here's what's really happening beneath the surface. A price peg is being established. Before the pizza transaction, Bitcoin's value was entirely theoretical. It was priced based on electricity costs, or the whims of forum members trading fractions of cents. The price moved because people whispered numbers at each other. It had no anchor. It was a ghost. The pizza transaction anchors it. 10,000 BTC equals 2 pizzas, $35 to $41. Now you can do math. Now you can extrapolate. Now value becomes real. By the end of 2010, the pizza index shows Bitcoin trading at roughly 1 cent. Fast forward to 2011, Bitcoin reaches $1, $2. By 2013, it's worth $100. By 2010, it peaks at nearly $20,000. Each time, investors and analysts reference the pizza. Remember when you could buy pizzas for Bitcoin? Look how far we've come. The pizza becomes a measuring stick for the currency's success. It becomes a marketing tool. It proves that Bitcoin isn't just code. It's not just a theoretical cryptographic experiment. It's a medium of exchange. Jeremy Sturdivant, by the way, doesn't hoard the coins. He's not Satoshi. He doesn't disappear into the cryptographic void. He actually does something interesting with the 10,000 BTC. When they reach approximately $400 per coin, a 10x return on his $35 investment, he sells them. He uses the proceeds to fund a road trip with his girlfriend. He uses some of it to buy indie video games from the Humble Bundle platform. This is significant. This is the first person in Bitcoin history to actually use the currency to live, to enjoy experiences, to travel, to fund art. He doesn't see Bitcoin as digital gold to be hoarded for a decade. He sees it as cash, as medium of exchange, as the whole point. Both Laszlo and Sturdivant understand something that most cryptocurrency enthusiasts get wrong. A currency without velocity is not a currency. It's a collectible. A currency that doesn't move, that doesn't circulate, that doesn't exchange for goods and services. That's just a digital ledger entry. That's just numbers. Meaningless. But now we're seeing a kind of macroeconomic reversal. Bitcoin, in October 2025, reaches an all-time high of approximately $126,000 per coin. The market is euphoric. Everyone is making money on paper. Price projections are absurd. Some analysts predict 200,000. Some say 500,000. The bull market feels infinite. Then, in November, something shifts. Massive outflows from Bitcoin ETFs. Institutional investors taking profits. Macroeconomic headwinds. Interest rate forecasts. Suddenly, the price cascades down. 33% decline in weeks. Bitcoin falls from 126,000 to 84,000. It's not catastrophic by historical standards, but it's enough to trigger panic. Margin calls, liquidations, leverage unwind. The same realization that markets, even cryptocurrency markets, can evaporate in minutes. And here's what's fascinating. We're 15 years past the pizza transaction. The infrastructure has grown exponentially. There are custodians, there are exchanges, there are ETFs, there are regulatory frameworks. And yet, the market is still vulnerable to the same cascade effects, the same algorithmic feedback loops, the same circuit breaker failures. We have maturity without stability. We have size without robustness. In 2018, he buys pizza again. Same Papa John's, same pizza. But this time he uses the Lightning Network, a second-layer solution built on top of Bitcoin. It's instant. It costs nearly nothing. There's no delay, no waiting for confirmations, just transaction. The photos from 2018 are the ones everyone remembers. His kids in E3 Bitcoin t-shirts, smiling, professional lighting, the photo that gets printed on every Bitcoin magazine cover. That gets shared on Reddit. That becomes the symbol. But the 2010 photos are the real ones, the ones that matter. The harsh flash, the greasy pizza, the tiny hands, the ordinariness. That's when it was real. When nobody was thinking about marketing, when it was just dad and kids and pizza. The pizza index is the crypto world's version of the Big Mac index. Economists use the Big Mac index to measure purchasing power parity between currencies. You go to McDonald's in Tokyo. You go to McDonald's in New York. You compare prices. You understand exchange rates through a standardized product. except it tracks Bitcoin's purchasing power over time. May 2010, 10,000 BTC costs approximately $41. That's 0.0041 cents per coin. 2015, 10,000 BTC is worth approximately $2.4 million. That's $240 per coin. A 58,000x increase in 5 years. May 2025, 10,000 BTC is worth $1.1 billion at mid-year prices. That's $110,000 per coin, a 26.8 million x increase from 2010 to 2025. Think about that math. Actually think about it. Laszlo Hanyecz didn't just spend coins, he didn't just make a purchase. He documented appreciation. He created a time-stamped, immutable record of value growth that's more dramatic than any financial instrument in history. The stock market, real estate, gold, commodities, none of them have appreciated at this scale, in this time frame, to this degree of certainty. But here's the thing people miss. This appreciation only exists because Laszlo spent them. If he had hoarded all 10,000 BTC, there would be no price peg. There would be no market comparison. There would be no proof of concept. The price might be higher. The scarcity argument might be stronger. But the utility argument would be dead. Bitcoin needs to prove it can be spent. It needs to prove it can circulate. It needs pioneers willing to move the coins. To test the system. To accept the risk that they might be worthless. At the exact moment when caution would have been rational, when sitting tight and waiting would have been smart, he spent them anyway. At the peak valuation of late 2025, 10,000 BTC is worth $1.26 billion. Let's do the calculations that make your brain hurt. 2 large Papa John's pizzas contain approximately 16 slices combined. That means each slice cost Laszlo $78.75 million, $78 million per slice. So Laszlo paid $252,000 per calorie consumed, $252,000 for 1 calorie. It's an obscene number. It's incomprehensible. If you ate 1 slice per day, it would take you 16 days to consume this pizza. In 16 days, at $78.25 million per slice, you'd be consuming pizza worth $126 billion. Your daily caloric intake would cost you $78.75 million. For context, that's more than the annual GDP of some countries. That's more than the cost of private jets. It's staggering. And yet, Laszlo treats it like he's buying lunch. In the shadow of Laszlo, there's a character most people forget. A Bitcoin Torp user called Rybuck. The smallest unit of Bitcoin W0LOLL1 BTC should have a name, a nickname, an identity. Satoshi, Rybuck suggests, named after Satoshi Nakamoto, the creator. 1 Satoshi equals 100 millionth of a Bitcoin. By 2025, every major exchange, every wallet, every cryptocurrency platform displays prices in Satoshis. It's the standard unit of account. Without Rybuck's naming convention, the entire cryptocurrency ecosystem would be fractionally different. The user experience would be different. Rybuck doesn't get mentioned in most Bitcoin histories. But Rybuck changes everything. Later, Rybuck copies Laszlo's pizza post format. He tries to buy food with other altcoins, Litecoin, Dogecoin. The post format becomes a meme. It persists in crypto forums for years. Pizza for Doge, someone will write. Tacos for Litecoin? The format becomes standardized. The pizza template lives on. Here's something rarely discussed. The pizza transaction was not a one-off. Other food. Goods. He estimates that over the course of that summer in 2010, he spent approximately 100,000 BTC, not just 10,000. 100,000 coins. At 2025 valuations, Laszlo spent $12.6 billion on takeout and goods that summer. $12.6 billion. This makes him, in retrospect, the largest consumer spender in human history. The amount of wealth he transferred through spending is incomprehensible. If that spending had happened in 2025, it would be the equivalent of Bill Gates and Elon Musk and Warren Buffett combining their annual spending and tripling it. It would be the largest transfer of wealth through consumption ever recorded. And it was all pizzas and random goods, all circular economy activity, all proof of concept. What if Laszlo hadn't spent those coins? What if he'd hoarded them? The velocity argument is crucial. A currency that doesn't circulate is not a currency, it's a collectible. It's a store of value, maybe. But it's not a medium of exchange. Without Laszlo and others proving that Bitcoin could actually be exchanged for goods, the network might have stagnated as a scientific curiosity, a purely speculative game played by math nerds. It might have never crossed the threshold into being money. But there's more. Sturdivant, selling the coins back into the market, distributed the supply. If Laszlo had hoarded his 100,000 BTC, he would have controlled a massive percentage of the total supply. The network's egalitarian ethos depends on distribution, on decentralization, on the coins being spread across many holders. Laszlo spending and moving his coins distributed them, made the network stronger, made centralization of power less possible. It was a sacrifice for the good of the system, whether he intended it that way or not. Here's where the story connects to your life right now. In late 2025, the cryptocurrency market is in turmoil. Prices are crashing. Fortunes are being lost. Margin calls are liquidating positions. The euphoria of October has been replaced with the anxiety of November. And in the midst of this chaos, there's James Howells. His lawsuit has been dismissed. His hard drive is still in the landfill. His $750 million is still buried beneath garbage. He's spending his days trying to figure out what comes next, how to process the loss, how to move forward. Compare that to Laszlo Hanyecz. He's working, he's coding, he's integrated Bitcoin payments into multiple platforms, he's lived a life. He's had experiences that those billions of dollars could never have bought him. Travel, family, work satisfaction, purpose. It's about choice. Laszlo made an active choice to spend, to circulate, to move the coins. James made the passive choice to hold, to sit, to wait, and then lost everything through an accident. The lesson is visceral. Active participation in a system beats passive observation. Movement beats stagnation. Utility beats hoarding. In 2025, as Bitcoin crashes, as the market convulses, as people panic and sell and regret not selling and regret selling, Laszlo's choice becomes more relevant, his decision to spend. To test. That's the decision that matters, not the amount of money, the principle. By 2025, the pizza transaction has become the origin story of modern finance. It's taught in business schools, it's referenced in documentaries, it's the founding myth of the cryptocurrency era. And the infrastructure that exists in 2025 owes everything to that decision. The Lightning Network, the Layer 2 scaling solutions, the instant payment rails, the RWA real-world asset tokenization, all of it traces back to the need to make Bitcoin spendable, to make it practical for everyday transactions. The Lightning Network specifically is fascinating. It was built to solve exactly the problem that the original pizza transaction created. In 2010, buying pizza took time. It required multiple confirmations. It was slow. It was clunky. Proof of concept achieved. By 2018, when Laszlo bought pizza again, the Lightning Network solved those problems. Instant settlement. Near zero fees. No waiting. The circle was complete. To Laszlo's willingness to test it publicly, to demonstrate the problem, to show what needed to be fixed. Laszlo's transaction was the first real-world asset purchase, the first time physical goods were exchanged for cryptocurrency. By 2025, this concept has metastasized across the entire economy. Government bonds are tokenized, real estate is tokenized, fine art is tokenized, commodities are tokenized. Everything that has value is now being converted into digital tokens, traded on blockchain, settled instantly. James Howells, in his desperation, even attempted to tokenize his lost hard drive. Shinyog coins, he called them. He issued tokens as a fundraising mechanism to pay for his legal battle, a derivative of the original Bitcoin. An asset whose value is entirely dependent on the value of another asset that he doesn't actually own. It's the final irony. The hard drive that contained Bitcoin becomes a cryptocurrency itself. Howells turns his loss into a speculative instrument. He's tokenizing his own despair. Most people forget the environment that May 2010 created in. The Deepwater Horizon oil spill is in full catastrophe mode. Millions of gallons pouring into the Gulf of Mexico daily. The beaches of Louisiana are being coated. Pelicans are covered in crude. The news is apocalyptic. The mood is one of pending environmental collapse. In this context, Laszlo's transaction takes on additional meaning. He's mining Bitcoin using GPU computation. It requires electricity. It requires power. It's not carbon-free, but it's not as carbon-intensive as traditional finance. Not as power-hungry as the traditional banking system. Bitcoin mining, even in its earliest days, was more efficient than the alternative. It didn't require physical buildings. It didn't require travel. It didn't require armies of employees. It was pure computation. And in May 2010, when environmental anxiety is at a peak, when the oil spill is the dominant news story, the idea that a currency could be created without the infrastructure of traditional finance, that's compelling. That's revolutionary. That's the difference between a centralized system requiring physical bank branches and a decentralized system requiring only computation. We mentioned the flash crash earlier. May 6, 2010. The bureaucracy is slow. The market, supposedly the most efficient allocation mechanism in history, had just demonstrated that it was fundamentally fragile. Bitcoin, by contrast, continued producing blocks. Steady. Reliable. Indifferent to Wall Street's panic. No circuit breakers, no regulatory halts, no fat finger traders crashing the network, just mathematics, just cryptography, just code. That's the psychological moment. That's the seed. That's why, 2 weeks later, when Laszlo posts his pizza offer, there's context. There's a rationale. There's proof that the traditional system is broken. And there's an alternative, clunky, slow, but not broken. Simultaneously, Greece is in freefall, Athens is burning, the European Union is issuing emergency bailouts, governments are printing money, the currency is being devalued. The infrastructure that people depend on for economic stability is revealing itself to be compromised. For someone like Laszlo, someone who understands systems, who sees failure points, who is ideologically committed to the principle that centralized systems are inherently unstable, this is validation. This is proof. The system they predicted would fail is failing. Bitcoin is the answer, not the practical answer yet. Bitcoin is worth nothing. You can't buy a mortgage with it. You can't pay taxes with it. But philosophically, theoretically, mathematically, it's the answer. Laszlo spending 10,000 BTC on pizza is his way of voting. Voting for an idea. Voting for the principle that currency should be decentralized, that it should move freely, that it shouldn't depend on governments or banks or failing institutions. The pizza is the ballot. There's a generational element to this story that matters. Laszlo and the early Bitcoin community were shaped by a specific set of failures: the dot-com crash, the war on drugs funding the CIA, Edward Snowden's revelations, which come later, but the paranoia is already present. A cumulative sense that institutions had failed. For Gen X and millennials, there was a different relationship to institutions than their parents had. Skepticism was default. Paranoia was not paranoia, it was preparation. The cypherpunk movement emerged from this world. Cryptography. Decentralization. These weren't fringe ideas. They were responses to genuine systemic failures. Bitcoin, in this context, wasn't just money. It was politics. It was philosophy. It was a response to a world that seemed fundamentally broken. Jeremy Sturdivant, at 19 years old, represents the next generation. Younger, even more comfortable with technology, even more skeptical of institutions. He doesn't need to be convinced that decentralization is necessary. He assumes it. He builds on it. When he spends his real money, his credit card to front the pizza purchase, he's not hedging. He's not being cautious. He's being consistent. He's saying, I believe this enough to risk my own cash. What if Jeremy Sturdivant hadn't seen Laszlo's post? What if he lived in a different time zone? What if the forum had crashed that day? What if his credit card had been declined? The transaction doesn't happen. Bitcoin continues as a curiosity, a mathematical experiment. Without the pizza transaction, does Bitcoin ever achieve utility? Does it ever gain real-world value? Is it possible it would have stalled, would have crashed, would have been forgotten in 2015? History hinges on small moments, on individual decisions, on the willingness of a 19-year-old student to risk $40 on a concept he believed in. What if James didn't throw away the hard drive? What if he'd organized better? What if the landfill didn't accept that particular batch of trash on that particular day? His life would be radically different. He wouldn't be in litigation. He wouldn't be in pain. He would just be rich, sitting on $1 billion fortune. No agency, no active choice, just passive holdings. By 2025, the pizza transaction has become myth. It's been retold so many times that fact and fiction have blurred. People think Papa John's accepted Bitcoin directly. Sturdivant was the intermediary. People think Laszlo is living in poverty and regret. That's false. He's working, he's comfortable, he's explicitly stated no regrets. People think the photos show some grand moment. They don't. They show dad and kids eating dinner. The mythology is more powerful than the reality. The myth is, a man spent a fortune on pizza and regrets it. The reality is, a man tested a system, proved it worked, and feels satisfied about his role in bootstrapping an economy. The mythology serves the narrative of Bitcoin pessimists. It's the story they tell to scare people away. Look what you lose if you spend Bitcoin. But that's a fundamental misunderstanding of what the pizza transaction actually represented. It wasn't a loss. It was a sacrifice. It was an investment in the network. It was infrastructure. It was the moment the network transitioned from theoretical to practical. Here's what's undeniable. Without that transaction, Bitcoin doesn't have a price history. Without a price history, the market doesn't develop. Without market development, there's no ecosystem. Without an ecosystem, there's no trillion-dollar industry by 2025. Laszlo Hanyecz literally bootstrapped a global financial system. He did it by buying pizza, by proving a point, by being willing to spend, to test, to risk in 2025 as the market crashes, as people panic, as fortunes evaporate. The image of those two greasy pizzas, the harsh flash photography, the tiny hands reaching, the ordinary cardboard boxes, that image remains a constant. A touchstone. A reminder that this whole thing started with something incredibly simple, something mundane, something human, with the desire to get food without leaving the house, with a programmer willing to experiment, with a student willing to risk. The economics of 2025 are incomprehensibly complex. Derivatives, futures, options, synthetic assets. It's abstraction stacked on abstraction. But underneath it all, there's still that pizza, that trade, that moment when digital code became physical sustenance. That's the bedrock, that's the foundation, that's what every subsequent transaction is built on. The story of the 10,000 BTC pizza is not a story of regret. It's not a tragedy. It's not even really a story of lost fortune. It's a story of utility creating value, of movement creating markets, of sacrifice building systems. Laszlo Hanyecz proved something that most people still don't understand. Value isn't static. Value isn't hoarded into existence. Value is created through exchange, through use, through the willingness to circulate. The coins he spent could have been worth nothing, could have crashed to zero, could have been forgotten entirely in a dead-end experiment. He took that risk. He accepted that uncertainty. He spent them anyway. And by doing so, he did something remarkable. He didn't just buy pizza, he created a price peg. He established the first exchange rate. He proved the concept works. He began a chain of events that leads directly to the trillion-dollar cryptocurrency ecosystem of 2025. Is he the richest person involved in early Bitcoin? Probably not. Is he the most famous Bitcoin owner? Probably not anymore. That's likely Satoshi, or the early venture capitalists, or the institutional investors who bought in the 2020s. But is he the most important? Possibly. Because without his proof of concept, none of the others could have existed. The pizza transaction sits at the intersection of three things: idealism, practicality, and timing. Idealism in the belief that decentralized currency could work, practicality in the decision to test it publicly. Timing in the moment. May 2010, when the traditional system was demonstrably failing. That's why it matters. That's why it endures. Now, you're probably thinking, okay, cool story, history is interesting, but why should I care? How does this connect to my life in 2025? Here's the connection. The choices you make about how you spend money, how you engage with technology, how you choose convenience versus principles, those matter. Laszlo could have been cautious, he could have held, he could have waited for more certainty. Instead, he moved, he tested, he acted. And that action created options for everyone who came after him. So the question for you is, what system are you building? What are you creating through your choices? Are you passive? Are you waiting for certainty? Or are you active? Are you testing? Are you taking risks on things you believe in? Because history shows that the people who move, who spend, who test, who take risks, those are the people who matter. Those are the people who create the world that everyone else inherits. The pizza isn't really about pizza. It's about agency. It's about choosing to participate. It's about being willing to spend on the things you believe in, even when, especially when, the outcome is uncertain. That's the real lesson. That's the lasting impact. If this story resonated with you, if you want to understand how fortunes are made and how systems are built, subscribe to this channel. We dive deep into these moments, the moments that change everything, the moments where ordinary people make extraordinary decisions. And in the comments section below, answer this question. If you had been in Laszlo's position in May 2000 Bitcoin and zero guaranteed value, would you have spent them? Or would you have held? Let me know. Your answer says something about how you approach risk, how you approach opportunity, how you approach the future. We're coming back next week with the story of Silk Road, the first darknet marketplace, the first platform to actually use Bitcoin as currency at scale, and the man who built it. A story of idealism twisted into criminality, of a system designed for freedom used for trafficking, of how good intentions can manifest as catastrophic outcomes. See you then.